Welcome to the debate. We're diving into a fundamental tension in high finance today, one that lives not just on the balance sheet, but really in the pit of the stomach.
That tension is profoundly real. It's the paradox of the higher earner, right? Their net worth is climbing rapidly on paper, but their nervous system just tightens with the approach of that single, large leverage payment. The spreadsheet is screaming, accelerate! But every instinct warns of impending stress and, well, ruin.
Exactly. We aren't just discussing mathematical efficiency here. We are discussing the mental trade-off faced by nearly every successful investor. And so our central question today is whether financial leverage is a rational precision tool for accelerating wealth, or is it merely an optimization disguise for a stress multiplier that ultimately reduces long-term success? I'm going to argue that leverage is a strategic necessity, backed by rigorously managed quantitative models that convert future stability into immediate speed.
And I come at it from a completely different angle, arguing that the behavioral and systemic risks that are inherent in leverage just overwhelmingly outweigh any of the theoretical benefits. Leverage is fundamentally a fragility multiplier. It guarantees that when the inevitable crisis hits, you are primed to make the worst possible decisions.
Well, let's get into that. Leverage, when it's deployed correctly, is an instrument of strategy, not desperation. It's used deliberately by sophisticated investors to unlock liquidity and, critically, to preserve ownership. Think of something like securities-backed lending, or SBL. This is where you borrow a modest amount against the value of your existing high-performing investment portfolio.
A modest amount being the key phrase there.
Right, a modest amount. Because the point of SBL is to avoid liquidation. If you need cash for a real estate down payment or a private venture, the alternative is selling assets, which triggers immediate capital gains taxes, and it cuts off your exposure to future market growth. So strategic leverage acts as a bridge. It allows you to monetize predictable cash flows without disrupting your long-term compounding machine. And this decision, it's quantifiable. We can look to frameworks that ask, how much speed can we safely generate? These models, they define the optimal amount of risk you should take by maximizing the expected risk-adjusted return, or RARE. RARE essentially tells you how much extra return you're getting for every unit of risk you're forced to take on. So when the expected return from the market clearly exceeds the cost of borrowing, leverage mathematically increases your RARE. It's an effective tool for pulling forward compounding.
A 10% gain can turn into a 50% return on cash if you're conservatively leveraged. The goal is disciplined growth acceleration over time. And the math, particularly something like the Kelly criterion, it shows us how to determine the optimal speed to maximize that long-term growth.
That's a very powerful defense of maximizing expected returns. But that entire framework, it overlooks the fundamental existential threat that leverage introduces, and that is the risk of ruin. We have to stop conflating two very, very different types of probability. On one hand, we talk about ensemble probability, which is the average outcome across a huge group of people, like a casino. On average, the group loses, the casino wins. But then you have time probability. This governs the single individual, repeatedly exposed to risk over their lifetime. And if you, as one person, repeatedly engage in an activity with even a non-zero chance of ruin, time probability dictates you are almost certain to end up in the cemetery. Leverage introduces that existential risk. Even using the mathematically optimal Kelly criterion that you mentioned, you're implicitly agreeing to drawdowns that are, frankly, intolerable in the real world.
For example, under standard market assumptions, taking a full Kelly position means you have a coin flips chance, a 50% probability, of experiencing a 50% drawdown. Half your capital gone, even if the math says you're right long term. And beyond that, leverage turns normal life volatility, a job change, a health issue, into a financial shock. A 20% drop in asset value on a 50% margin is a devastating 40% loss of your initial capital. This proximity to constraint introduces crushing financial stress, which consumes valuable cognitive resources, what we call bandwidth, and that leads directly to terrible decisions made under pressure, which just destroys all those theoretical gains you've outlined.
You correctly highlight the dangers of over-optimization, and I would agree that Full Kelly is often impractical. It's a theoretical maximum. That is precisely why real-world application demands disciplined fractional Kelly investing. This isn't about being fully exposed, it's about controlled, measured risk-taking.
Okay.
So if we move from a full Kelly position to, say, a half Kelly position, the mathematical trade-off is extremely favorable to stability. The probability of experiencing that catastrophic 50% loss you described, it drops dramatically. It plummets from 50% all the way down to 12.5%. And yet, the long-term growth rate only drops by a modest 25%. This demonstrates that the risk is entirely manageable. We just have to establish a controlled upper bound on risk-taking. We define the risk, we underwrite the worst case, and we control the outcome. The risk is controllable, not existential, when it's managed with intentional conservatism.
I respect the math of fractional Kelly, I really do. But that entire approach rests on the assumption of a perfectly rational actor who can stick to a rigid plan, and that the financial environment behaves according to standard distributions. And this is where the models just completely fail. The discipline you're championing is incredibly fragile because you are underestimating path dependence. The sequence of returns matters so much. We know that Monte Carlo simulations based on standard, bell curve distributions give investors a false sense of security. But when you introduce realistic, catastrophic tail risks or heavy tails, modeling outcomes where crashes are far more common than theory predicts, the potential path changes dramatically. These events dramatically increase both the maximum drawdown and the conditional expected drawdown. You start to see the presence of ruin even at surprisingly low levels of initial leverage. The ability to survive the path is often more important than maximizing the theoretical end result, because if you don't survive the path, you never get to the destination.
And let's connect that drawdown risk to the psychological reality. The cost of leverage is not just the interest rate. It is cognitive. When leverage pushes a household closer to that financial constraint, they spend invaluable time and cognitive bandwidth just worrying about margin calls or refinancing risk. It's been observed that this financial stress actually impairs a person's productive labor supply. It crowds out their ability to focus on high-value work. Now, sophisticated investors might have the resources to save their way out of that stress region, but the general effect is a kind of poverty trap where chronic worry impairs productivity, that leads to lower net savings, and it just perpetuates the cycle. Leverage takes a rational, high-earning person and subjects them to the cognitive limitations of extreme financial distress, making them prone to panic selling just when calm is needed most.
That's an interesting point on the cognitive cost, but I would argue that strategic deployment of leverage is designed precisely to avoid this cognitive constraint by harmonizing your financial capital with your human capital. Consider the example of a young high earner, maybe a tenure professor or partner track professional. Their lifetime earning potential is extremely secure. That human capital is essentially a massive bond-like asset guaranteeing stable income for decades. So they are theoretically underexposed to risk assets because so much of their net worth is tied up in that safe, guaranteed future salary. Therefore, they can rationally justify using financial leverage on their investment capital to reach their ideal overall risk exposure. They're just using leverage to fill a capital gap based on their stable future income. This is the entire principle underlying the leveraged life cycle strategy, which generated a very clear advantage over conventional balanced strategy. Leverage isn't creating stress here. It's acting as a temporary bridge to align the investor's current portfolio with their long-term stable risk capacity.
But let's look closer at those life cycle strategies you bring up. The material shows that while the leveraged life cycle strategy was better than the standard balanced approach, it was ultimately inferior to the dynamic life cycle strategy. And that inferiority speaks directly to the fragility that's inherent in debt. Leverage creates interconnected obligations. It's not a single isolated decision, it's a system. The 2008 global financial crisis highlighted the complete failure of these deterministic, fixed glide paths, the kind that are often required when you're using long-term, high-commitment debt. They just invariably created refinancing risk and forced asset allocation decisions at the absolute worst possible moment. Dynamic strategies, on the other hand, They adjust allocation flexibly based on how the portfolio is actually performing. They retain flexibility when stress hits. Leverage sacrifices that flexibility. It pushes investors into what I call the systemic trap, forcing them to sell low or refinance high because they are constrained by the calendar, not by their own strategy.
I'm not convinced that dynamic strategies necessarily negate the value of judicious leverage, though. The high net worth individual using low loan-to-value SBLs is often doing so precisely to preserve flexibility. Liquidity and optionality are preserved in the near term by avoiding liquidation. The alternative is selling, paying taxes, and permanently removing that capital from the market. Strategic leverage maintains exposure and potential upside. We have to distinguish between leverage used as a destructive identity, just piling up debt to speculate, and leverage used as a strategic bridge. The latter is underwritten conservatively. It assumes non-ideal market conditions, and crucially, it has a clear intent to unlock cash flow without selling high-performing assets. It's designed to buy time and maintain a market presence, which is the very definition of optionality.
But that optionality is illusory. It's an illusion because leverage changes the fundamental nature of risk tolerance into risk capacity. If you don't have the capacity to absorb a 40% loss of equity without breaking a covenant or facing a forced sale, then that leverage is not preserving your freedom, it's actively removing it. The moment you are leveraged, your decisions are governed by the counterparty, the lender, and the calendar. You lose the freedom to wait. And when high-performing assets suddenly become correlated during a crisis, all those safe debts layered across different obligations turn into a single, highly dangerous systemic threat.
And that is why the discipline has to be front-loaded. We're not advocating for leverage near the point of constraint. We are advocating for converting stable, low-variance financial positions into accelerated growth positions with clear conservative margins of safety built in from the start. When you leverage a 20% LTV, you have a 75% market drop before the institution even thinks about calling you. That is a substantial margin of safety, designed specifically to absorb the heavy-tailed events you're describing. The focus has to be on the underwriting, the discipline applied to the tool, not some inherent evil in the tool itself.
And yet, history is just littered with examples of disciplined investors who built massive margins of safety that were annihilated by correlation spikes and systemic freezes. The discipline of the model is always weaker than the stress induced by the market path.
So to summarize, the mathematical imperative for maximizing long-term outcomes, it demands that we look at stable financial positions, be they predictable cash flows or stable human capital, and efficiently convert that stability into speed via controlled leverage. When it's rigorously managed through conservative underwriting, defined risk metrics like fractional Kelly, and a clear strategic intent, borrowing is simply the most efficient method for maximizing the median long-term outcome. The risk is not in the tool, but in the failure to apply sufficient discipline.
That's the powerful defense of rational optimization. But the path, not the destination, is the risk. Leverage must be viewed primarily through the lens of fragility, not efficiency. It exposes the portfolio to heavy-tailed events and the risk of ruin, and it guarantees that under external stress, whether it's market turmoil or personal hardship, behavioral errors and cognitive costs will destroy any theoretical gains. The true battle is against the behavioral tendency to underestimate the length and depth of perfectly normal drawdowns, especially when those drawdowns are amplified by debt.
So, we'll leave you with this core thought. Based on what we've discussed, when considering the ultimate impact of taking on debt to invest, is the true cost of leverage the quoted interest rate? Or is it the irreversible loss of the freedom to wait?